Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional.
All right, we are diving into a really monumental set of sources today. It's all focused on Alphabet Inc.'s third quarter for 2025.
Yeah, and this wasn't just, a strong quarter.
No, not at all.
The numbers and really the commentary around them suggest this is a historical inflection point. It feels like AI has fully shifted from just being a research thing to being the absolute core driver, like the engine behind their financial success and definitely their future strategy.
Yeah, the core driver seems right.
And what really jumps out for these materials is just the speed and the scale of this change.
Right.
For listeners, I think this analysis is, well, pretty crucial because we're trying to look past the usual, quarter-over-quarter bump.
The incremental stuff.
Exactly.
Yeah.
We need to understand the truly massive structural investments the company is making right now. They're trying to lock in their long-term leadership in AI.
It sounds like a balancing act. It really does. This whole report feels like a financial tightrope walk. You've got this historic revenue success on one side, and then this just unprecedented commitment to capital expenditure, the spending on the other.
Okay, let's start with the big number then, the one that kind of puts everything else in context. Alphabet delivered its first ever $100 billion quarter.
Yeah, $102.3 billion in consolidated revenue.
That's just a massive milestone.
It is staggering, especially when you look at the history they provided.
What do they say there?
Well, they pointed out that just 5 years ago, their quarterly revenue was around $50 billion.
Wow. So they doubled it.
Doubled it.
Yeah.
In 5 years. And think about the period, intense global economic stuff, huge tech disruption.
Right. Not exactly smooth sailing globally.
Not at all. So it really confirms that these underlying strategic shifts, diversifying the business and now really powered by generative AI, it's working. It's actually yielding accelerated growth across, well, basically every major part of the company.
And that's the key, isn't it? The growth wasn't just in one spot.
No, absolutely not.
We saw double-digit increases pretty much everywhere. Search, YouTube ads, subscriptions, Google Cloud.
Yeah, across the board.
So the main theme here is pretty clear. AI is now the fundamental mandate. It's driving the business results. It's driving the strategy. It's woven into search, cloud, those growing subscription businesses.
Exactly. The company clearly sees its current momentum as firmly rooted in this generative AI era.
Okay.
So our goal today, I think, is to really unpack 3 critical pieces of this AI mandate.
All right. What are they?
First, the strategy itself, the brilliance, maybe, but also the cost of their full stack approach to AI, the infrastructure, the models.
Okay, the full stack. Got it.
Second, we need to look closely at the search business.
Yeah.
How the economics of monetizing it are changing, evolving, because it's proving way more resilient than, some skeptics initially thought.
Right, there's a lot of worry there.
A lot. And finally, we absolutely have to look at the rocket ship that is Google Cloud. Because that acceleration is, well, it's the direct cause of this massive, maybe necessary infrastructure spending spree we're seeing.
Okay, sounds like a plan. Let's start with that AI strategy, the full stack approach. What exactly do they mean by that? It sounds comprehensive.
Oh, it's definitely comprehensive. And it sounds like a serious attempt to basically control their own destiny in this new AI world.
Existential almost.
I think that's fair. To compete at the absolute top tier, the frontier of AI, they seem to believe they have to control the whole value chain.
From the silicon up.
Pretty much, from the basic hardware right up to the consumer product. So the 3 pillars they talk about are clear. 1, AI infrastructure, that's the hardware, the data centers.
Okay.
2, world-class research and models, that's the IP, the algorithms, the tools.
The brains.
The brains, exactly. And 3, product platforms, how they actually bring those models to billions of users and, importantly, thousands of businesses.
And that first pillar, infrastructure, that's where the eye-watering sums of money are going.
That's the CapEx black hole, yeah.
And it's characterized by this interesting dual approach, right? Using both NVIDIA GPUs and their own custom chips, the TPUs.
Right, the tensor processing units. And this dual architecture strategy, I think, might be their most important competitive advantage right now, especially for cloud.
That's so.
Because they're not just, reselling somebody else's hardware. They design and build their own, too. So on one hand, yes, they're scaling up NVIDIA's best chips. They specifically mentioned these new A4X Max instances using the NVIDIA GB300. Those are apparently shipping now to cloud customers for general high-demand stuff.
Okay, standard high-end stuff, but then they have their own TPUs. Why double down on building those when NVIDIA seems to dominate the market? What's the rationale?
Because TPUs are specialized. GPUs are great, fantastic for general parallel computing, massive developer base, everyone knows how to use them.
Right.
But TPUs are specifically designed, architected for the kind of math you need for large language models, these huge matrix multiplications for training and inference.
So efficiency gains.
Huge internal efficiency gains.
Mm.
And by offering both, they can basically tell customers, hey, we've got the absolute best tool for whatever AI job you have.
Makes sense.
And we heard the next generation, the 7th gen TPU called Ironwood, is supposed to be generally available soon. So that internal development engine is definitely running hot.
And this breadth, this choice, it becomes a real advantage for GCP, for Google Cloud.
Oh, yeah. It translates directly into a serious structural moat, I'd say.
Speaking of moats, the demand for all this computing power, it sounds enormous.
Tremendous is the word.
The sources mentioned a specific, pretty startling figure about Anthropic.
Yeah, Anthropic, a major AI player, a partner, they've committed to accessing up to 1 million TPUs.
1 million. That number just,
Yeah,
it's hard to even process the scale of that.
it really is. 1 million TPUs. It basically means Alphabet is signing up to be the fundamental computing backbone for a huge chunk of the entire frontier AI ecosystem.
Wow.
This isn't just for their own internal stuff anymore. This is building a core global utility. And if you needed a justification for that huge CapEx number, we'll get to.
This commitment is pretty much it, right? They have to deliver this capacity now. They're obligated.
But let's pause on that for a second. Isn't there a huge risk in centralizing that much supply chain responsibility? Dedicating so much custom silicon to partners.
It's a calculated risk, I think.
They must be incredibly confident in their manufacturing pipeline.
They absolutely have to be. Look, this level of commitment probably helps them lock in partners, right? It offers custom optimizations, guaranteed reservations, which is incredibly valuable when supply is tight, like it is now. It might mitigate the risk of competitors just undercutting them on price for generic stuff.
Okay.
But yeah, you're right. Managing the production, the deployment, the cooling of infrastructure for 1 million custom chips, that's a logistical nightmare and a financial undertaking that, frankly, very few companies on Earth could even think about attempting.
It fundamentally changes their risk profile, doesn't it? From software bugs to like industrial scale infrastructure failing.
Absolutely. It shifts it significantly towards industrial scale reliability.
Okay, let's jump from the hardware, the infrastructure, to what it actually produces.
Yeah.
The models and the research side, they listed a whole arsenal of models.
Yeah, quite a list. Gemini 2.5 Pro, Veo for video, Genie 3, Nano Banana, and they're building anticipation for the bigger Gemini 3 release later this year.
And are these models actually being used at scale yet?
Oh yeah, the usage metrics they shared are pretty telling. Over 230 million videos already generated using Veo 3.
230 million, so generative video is moving fast.
Really fast. Moving into mainstream production, it seems. And crucially, they said over 13 million developers are now building apps using their generative models.
13 million developers. That's significant adoption.
It really is. It signals that their tools, their APIs are becoming essential for the global dev community. That accelerates getting their AI capabilities into all sorts of third-party software.
Now, something else caught my eye, a breakthrough that isn't just about the next couple of years, but maybe the next couple of decades. The quantum computing milestone.
Yes, the Willow chip. This is really important strategic positioning.
What did it achieve exactly?
So the Willow quantum chip ran a complex algorithm 13,000 times faster than one of the world's top supercomputers.
13,000 times faster.
Okay. But here's the really important part, the technical detail. The result was verifiable.
Why is verifiability the key step?
Because quantum computing has always been theoretically powerful, right? But if you can't actually check or trust the answer it gives you, it stays kind of academic, stuck in the lab.
Right. Useless for practical problems.
Exactly. This breakthrough, this verifiability, suggests a path toward practical quantum utility. That's a massive step for things like drug discovery, materials science, these really complex next frontier problems.
It's a good reminder that their huge R&D budget isn't just going towards making Gemini better today.
No, it's about securing the next horizon of computing power altogether.
And it was interesting, they noted Michel Devoret, their chief scientist for quantum hardware, got acknowledged for a Nobel in physics.
Yeah, for his foundational research, it just reinforces the kind of, top-tier scientific talent they have focused on this area.
They're attracting and keeping the brain power needed for these really long-term bets.
Absolutely. It creates a powerful long-term intellectual property moat.
Okay, finally on the AI front, let's talk scale. What the data seems to be calling the token tsunami.
Right, the token tsunami. This metric, I think, is the clearest indicator of just how fast AI is being adopted across all their products.
So what were the numbers?
They reported processing 980 trillion monthly tokens back in Q2.
Okay, already a huge number.
Now in Q3, that jumped to over 1.3 quadrillion monthly tokens.
Quadrillion. Wow. And year over year.
That's a 20x growth year over year.
Okay, let's pause there. For listeners, what exactly is a token in this context?
Good question. Think of a token as the basic building block for AI interaction. It could be a whole word, sometimes a part of a word, maybe even just punctuation.
So when you ask a complex question in search, or get AI to help write an email,
You're consuming tokens, hundreds, maybe thousands of them for a single interaction.
so 1.3 quadrillion tokens a month. That's basically measuring the total computational workload across their entire ecosystem.
Exactly. It's like the underlying fuel gauge for the whole AI stack. It covers everything. Search, cloud, even devices like the new Pixel phones using their Tensor G5 chip, which is built around Gemini.
And that 20x year-over-year growth.
It shows users aren't just trying AI out. They're using its most powerful, most token-hungry features, complex summaries, generating text or images, multimodal stuff at this staggering exponential rate.
So this metric directly justifies the huge infrastructure spending.
It's a direct feedback loop. It validates the need for that massive CapEx. If the token count stopped growing, the spending argument gets weaker. But right now, the tokens are screaming for more chips.
Okay, so with that infrastructure context laid out, let's look at how AI is actively changing their biggest business, search. Management called this an expansionary moment.
Right. And this is where we hit that long-running worry in the market.
The idea that AI answers would kill clicks.
Exactly. The conventional wisdom was, if AI just gives you the answer directly in, say, an AI overview, why would you click? Users would search less, click volume drops, monetization tanks.
But the sources say the opposite is happening.
The exact opposite.
Right.
What the materials reveal is that these new AI experiences, specifically AI overviews and the separate AI mode, are actually driving growth in overall queries and, critically, growth in commercial queries year over year.
And the growth rate picked up in Q3.
It actually increased in Q3, which suggests that as people adopt these AI features, it's accelerating the total size of the pie, not just, slicing it differently.
Okay, that's a really crucial point. Is it that people are asking more complex questions now, or just questions they wouldn't have bothered typing into the old search box?
It seems like both, but maybe more of the latter. The conversational style of AI mode makes it easier to ask those more complex multi-step questions.
The kind that often lead to buying something.
Precisely. The kind that signal commercial intent. Like instead of searching best running shoes and then clicking filters, you might ask an agentic query like, plan a 5-day family trip to Tuscany for 4 people. Find a villa with a pool and list 3 rental cars big enough for us available at Florence Airport.
Right, much more involved.
And the data apparently shows this effect is particularly strong among younger users, which points to maybe a structural shift in how the next generation is going to interact with information online.
Let's talk more about AI mode specifically. That's the more conversational interface.
Yeah. And they said it's seeing strong, consistent week-over-week growth since it launched in the U.S.
How strong?
Queries apparently doubled just over the quarter, and they've rolled it out fast. It's now global, across 40 languages.
Yeah, and the user numbers.
Already over 75 million daily active users. That speed of adoption is pretty remarkable.
And the bottom line, impacts on search volume.
This was key. Management stated explicitly that AI mode is already driving incremental total query growth for search. It's adding net new volume. It's not cannibalizing the core search.
Which brings us right to the trickiest part. Monetization. The billion-dollar or maybe trillion-dollar question. How do these new AI interfaces make money compared to the old click model?
Yeah, the market's been worried about this for ages.
So how did they address it?
They talked about a bit of a philosophy shift. They said they're managing the business for great user outcomes and providing attractive ROI, return on investment for advertisers.
Rather than just chasing clicks.
Exactly. Rather than being solely focused on maximizing paid clicks or driving up CPCs, cost per click, the idea seems to be that a really satisfied user who actually completes a complex task using AI is ultimately more valuable, even if the steps they took look different from traditional search clicks.
Okay, but before we get into the new AI ad stuff, what about the traditional ad metrics in Q3? How do they hold up?
That's essential context. Paid clicks were actually up 7% year over year. And CPCs, the cost per click, were also up 7% year over year.
So the old engine is still firing.
It shows the traditional engine isn't collapsing under the weight of AI adoption. It's still robust, still highly lucrative. It provides that stable financial base they need while they figure out and scale up the new AI monetization strategies.
And the main new strategy seems to be this product called AI Max.
Yeah, AI Max. They called it their fastest growing AI-powered search ads product, rolled out globally in September, used by hundreds of thousands of advertisers already.
Okay, so what does AI Max actually do differently?
Fundamentally, it changes how ad inventory is managed and matched. It uses these really sophisticated generative AI models to understand the context of a search, the user's likely intent, much better than before.
And the result is?
The result is it unlocks billions of net new queries for advertising.
Billions, how?
It's able to match advertisers to queries that were previously like too niche, too long tail, maybe too awkwardly worded for the old keyword matching systems.
So it finds value in searches that were previously hard to monetize.
Exactly. It delivers the most relevant ad across different surfaces, effectively expanding the total pool of commercial queries they can sell ads against.
It's like an economic force multiplier for their existing ad system, powered by better targeting.
Precisely. And they give a concrete example, Kayak, the travel site.
Right.
In early tests using AI Max, Kayak apparently saw their conversion value, the actual value of the bookings they got, grow by 12%.
While hitting their efficiency targets.
While maintaining their target ROAS, return on ad spend goals. So that's a measurable business win for the advertiser.
Which is key.
It really is.
Yeah.
The AI isn't just making the search experience nicer for users, it's making the advertising spend more efficient and more productive for businesses. And when advertisers see a 12% lift in conversion value,
They're likely to spend more.
exactly, which then further fuels that whole query expansion dynamic.
Okay, now let's tackle the really sensitive one.
Yeah.
The economics of AI overviews. Those AI-generated summaries at the top of the results. There was so much fear they'd kill monetization.
Right. Management made a pretty definitive statement here.
What did they say?
They stated clearly that AI overviews, even right now with the current baseline level of ads they show, monetize at approximately the same rate as traditional search results.
Wait, the same rate? That seems
Uh-huh.
huge. That defies all the predictions.
It's a very strong claim.
How are they achieving parity if people might be clicking less overall? Did the sources explain the mechanism?
They suggested it's a few things working together. First, because they're managing for user outcome, the AI is supposedly delivering really relevant, high commercial intent results. So when a user does click through to an advertiser from an overview, that click is extremely valuable.
Okay, higher quality clicks.
Higher quality clicks. Second, the AI overviews themselves can incorporate richer, more integrated ad formats. Think specific product cards, dynamic links embedded right within the summary text. These are likely more valuable than just a standard blue link.
More engaging formats.
Right. And finally, because the AI is better at understanding and classifying queries overall, they can place those high-value ads more effectively on all those incremental commercial queries being generated by things like AI mode.
So the combination offsets any potential drop in raw click volume.
That seems to be the argument. And this parity serves as like a really strong baseline. It gives them confidence to innovate further with richer ad placements in overviews down the line.
And the evolution isn't stopping at just summaries. It's moving towards more agentic commerce and travel experiences.
Yes, and this is where some of that external worry about lower monetization rates popped up again. The fear that the AI agent just completes the transaction itself, cutting out the ad revenue middleman entirely.
How does management view that?
They seem to view these agentic experiences as additive, as a way to help users complete more complex tasks, connect them with businesses more smoothly. The focus is on reducing friction, especially in those final steps of a purchase.
What are they doing specifically?
They mention things like integrating conversational shopping right within AI mode, expanding virtual try-on features for apparel, and using new agentic checkout capabilities.
Agentic checkout. How does that work?
It seems to rely heavily on partnerships. They specifically mentioned one with PayPal.
Okay, how does a PayPal partnership help here? What friction does it remove?
Well, think about it. An AI agent might help you find the perfect sweater, right size, best reviews.
Okay.
But then the final step is often this clunky handoff to an external website's checkout page where you might drop off.
Right. Happens all the time.
By integrating partners like PayPal directly into the flow, they can potentially enable a more native checkout experience. Fewer steps, maybe using payment info already stored with Google.
Making the final purchase step seamless within the AI conversation.
Exactly. That maximizes the chance the user actually completes the purchase, and that makes the whole agentic experience valuable to the merchant, ensuring that even though the path was different from a traditional ad click, it still delivered significant commercial value across the ecosystem.
Okay, that makes sense. Let's pivot now to Google Cloud. Huge success story this quarter, but also, as you said, the main reason for that massive infrastructure spending.
Yeah, cloud had an exceptionally strong quarter. It's really showing its maturity now as a core profit engine for the company.
What were the numbers?
Revenue grew 34% to $15.2 billion. And that was driven mostly by the strength in GCP, the Google Cloud Platform itself, which they noted continues to grow even faster than the overall cloud number.
And the profitability story.
Yeah.
The margins.
Really compelling. Cloud operating income jumped an incredible 85% year over year, hit $3.6 billion.
Wow, 85% growth in profit.
Yeah. And that pushed the operating margin up significantly from 17.1% last year to 23.7% this quarter.
It's getting much closer to AWS territory, isn't it?
It is. It's a remarkable margin expansion. For context, AWS has historically been higher, but Google Cloud is showing real scale efficiency now, moving rapidly towards that mid-20s range, which is a key benchmark.
And what drove that margin gain?
They attributed it mainly to the strong revenue growth, plus ongoing cost efficiencies. Although they did point out it was partly offset by higher costs for using all that technical infrastructure.
Including the depreciation we keep mentioning.
Including that accelerating depreciation, yes. But the key thing is they're expanding margins even while absorbing the costs of this massive infrastructure build-out.
So what's specifically fueling GCP's growth? Beyond just companies moving to the cloud in general, it sounds like it's all about AI.
Absolutely. The sources were very clear. Enterprise AI products are now generating billions in quarterly revenue. GCP's growth is directly linked to demand for their whole AI package deal.
The full stack again.
The full stack. That unique combo of their own TPUs plus high-end NVIDIA GPUs for the hardware, combined with their leading models like Gemini 2.5.
Yeah.
Enterprises aren't just buying basic computing, they're buying the entire AI ecosystem from Google Cloud, and that's way more profitable.
And the customer growth numbers back this up.
They really do. Two key things: customer count and deal size. The number of new GCP customers was up almost 34% year over year, but look at the size of the deals.
What about them?
They said they've signed more deals worth over $1 billion just in the first 3 quarters of 2025.
Billion with a B.
Billion with a B than they did in the entire previous 2 years combined.
Wow. That's serious acceleration and big commitments.
Yeah.
What do those billion-dollar deals usually involve in this AI era? Is it just services or is it locking up hardware?
It's often heavily weighted towards dedicated infrastructure reservations and long-term service agreements.
So guaranteeing access to chips.
Exactly. When a big AI company or a major bank signs a billion-dollar deal, they're often securing guaranteed access to specific clusters of GPUs and TPUs for years out.
That gives Google Cloud revenue stability.
Huge revenue stability, yeah. And it guarantees capacity for the client, which, in a market where high-end chips are scarce, is absolutely essential. These huge deals are basically foundational to their revenue forecast for the next 5, maybe even 7 years.
And it's not just about landing these huge new logos, right? It's also about getting existing customers to use more AI.
Correct. They said over 70% of their existing Google Cloud customers are now using their AI products.
Any specific examples?
Yeah, they mentioned Banco BV, Best Buy, Fair Price Group, and adoption of the generative AI products specifically is rocketing. Revenue from products built on those Gen AI models grew over 200% year over year in Q3.
200% growth.
Yeah, it shows their models are becoming really sticky, really indispensable tools for their current enterprise customers.
Did they share any examples of the actual efficiency gains these companies are seeing, like real-world impact?
They did, and some were pretty transformative. Apparently, in the last year, nearly 150 Google Cloud customers each processed around 1 trillion tokens using Google's models.
1 trillion tokens per customer. It's heavy usage.
Very heavy usage. And it translates into real savings, WPP. the giant ad holding company. They're seeing up to 70% efficiency gains in creating ad campaigns using Google's AI tools.
70%. That's not just tweaking things. That's fundamentally changing their workflow and cost structure.
Absolutely. Or look at Swarovski, the crystal company. They apparently increased email open rates by 17%. Okay, that's good. But they also accelerated localizing their marketing campaigns into different languages by 10 times.
10 times faster localization.
Yeah. Think about what that means. They can run global campaigns almost instantly now. That generates revenue faster and saves massive amounts on translation and coordination costs.
These kinds of results explain why companies are signing those billion-dollar deals.
Exactly. The AI stack is providing clear, demonstrable, sometimes transformative benefits to the client's bottom lines.
And Google is also packaging this AI up neatly for businesses.
Yes. The launch of Gemini Enterprise, their new AI platform for the workplace, seems to be getting huge traction already.
What kind of numbers?
It's already crossed 2 million subscribers across 700 different companies.
2 million subscribers quickly.
Very quickly. It suggests they're successfully moving beyond just offering custom model training towards selling these high-margin, pre-packaged AI agents designed for common business tasks, HR, finance, customer service, that sort of thing.
And this ties into the diversification point.
Yeah, they highlighted that Cloud now has 13 different product lines that are each doing over $1 billion in annual run rate revenue.
$13 billion businesses within cloud.
Right, so they're moving way beyond just renting out basic compute and storage.
Now, underpinning all this growth, all this confidence, is the cloud backlog. That number really exploded in Q3.
It really did. The cloud backlog, basically the future revenue they've already contracted but haven't recognized yet, hit $155 billion at the end of Q3.
$155 billion. How does that compare?
Well, it's up 82% year over year, which is already impressive. But get this. It was up 46% sequentially, just from Q2 to Q3.
Almost 50% growth in the backlog in a single quarter.
Yeah, and that massive jump directly supports the CapEx argument we keep coming back to.
How so?
It shows these huge investments aren't just speculative bets on the future. They're a necessary reaction. They have to spend this money to deliver on the commitments they've already made, the contracts they've already signed with clients who are desperate for this AI infrastructure. They are literally racing to build capacity just to meet the demand they already have locked in.
Okay, let's shift gears to YouTube. Management calls it the twin engine ads and subscriptions working together.
Right. YouTube advertising revenue was up a healthy 15%.
What drove that?
Mostly direct response ads, followed by brand advertising. And the biggest spenders contributing to that growth were retail and financial services companies. Shows resilience in those key ad markets.
And in terms of eyeballs, they're still dominant.
Yeah, Nielsen data shows YouTube is still #1 in streaming watch time in the US, and they've held that spot for over 2 years now. That's massive mindshare, especially in the living room.
What about Shorts, the short-form video competitor to TikTok? How's the monetization going there?
That was a major focus, and they hit a significant milestone. In the US, Shorts now actually earns more revenue per watch hour than traditional long-form in-stream video content on YouTube.
Wait, Shorts makes more per hour now in the US?
Yeah.
That seems counterintuitive.
It does, but it points to a couple things. First, engagement density. You just watch more videos, see more potential ad slots in an hour of Shorts compared to watching one long video.
Okay, more ad opportunities per.
Right. And second, AI-driven ad serving. Shorts allows for really efficient ad targeting and placement. They can use formats like non-skippable ads or highly contextual ads that benefit from all the improvements in their AI Max ad models we talked about earlier.
So the ad inventory itself is becoming more valuable.
Exactly. It makes Shorts inventory highly desirable for U.S. advertisers, driving up the effective price, the CPM.
Okay, so that's the ad engine. What about the second engine, the subscription flywheel?
That's growing fast, too. The total number of paid subscriptions across Google, that includes Google One for storage, plus YouTube Premium and YouTube Music, has now crossed 300 million.
300 million paying subscribers.
Yeah. And this base is really important for the whole YouTube creator economy flywheel.
How did the economics work there?
It's pretty straightforward and very favorable for YouTube. On average, they said, a YouTube Music and Premium subscriber generates meaningfully higher gross profit than a user who just watches ads.
Meaningfully higher gross profit. Why is that?
Yeah.
Is it just saving the cost of showing ads?
That's part of it. They avoid ad serving and sales costs. But critically, someone willing to pay is likely a highly engaged user, probably sticks around longer, higher retention.
Right, a more loyal user.
Exactly. And that higher, more stable gross profit per user allows YouTube to reinvest more back into the creator ecosystem. They can fund creators better, attract more exclusive content, get more viewers. It becomes this virtuous cycle.
The twin engine provides resilience too, right? If the ad market slows down.
Huge resilience. It smooths out the bumps from ad market volatility.
And AI is playing a role on the YouTube side too, for creators.
Absolutely, both in creating content and making money from it.
How so?
Well, AI is streamlining workflows for creators. They mention new generative video tools to speed up editing, AI insights to help plan channel strategy.
Okay, making creation easier.
Right. But on the monetization side, AI is now automatically identifying products that are mentioned or just appear in videos and making those videos instantly shoppable.
Ah, turning views into potential sales more easily.
Exactly. It shortens that path from discovering something in a video to actually being able to buy it. That expands the commercial opportunities for millions of creators dramatically.
We also saw some big numbers around their push into live sports.
Yeah.
That NFL game from Brazil.
Yeah, that exclusive global broadcast was apparently a huge success, drew over 19 million fans, and it set a new YouTube record for the most concurrent viewers ever on a live stream.
Proving the platform can handle massive live events.
Definitely. Proves the platform scale for premium, global, live content.
And does that scale translate into better results for advertisers on those live events?
It seems so. They gave a specific example of a brand collaboration during a live event. Dude Perfect, the trick shot guys, partnered with Comcast Xfinity.
Okay.
That campaign apparently drove an 8% lift in people searching for Xfinity later, which is good, but compared to Xfinity's other ads,
How did it compare?
it beat the ad recall lift of Xfinity's other ads on Shorts by 34%. And at the same time, it decreased the cost per lifted user, the cost to get someone interested enough to search by 50% compared to their next best performing ad format.
Wow. So much higher impact, much lower cost.
Exactly. It really showcases the efficiency gains brands can get by using these integrated, AI-optimized ad placements within YouTube's different formats, especially around popular content.
All right, let's pull back and look at the overall financial picture now. This provides the crucial context for that CapEx surge we keep circling back to. Can you recap the headline numbers again?
Yeah.
Consolidated revenue was $102.3 billion.
Right. Operating income was $31.2 billion, which was up 9%. Net income was $35 billion, up a strong 33%. And free cash flow for the quarter was robust at $24.5 billion.
So overall, very healthy financially, generating tons of cash.
Exceptional cash generation capacity, which is essential, right? Because that cash is what's funding this colossal infrastructure build-out.
Okay, but we have to talk about the impact of that big European Commission fine. $3.5 billion? That skewed the operating margin, didn't it?
It did, and that context is really important for understanding the underlying health. That $3.5 billion charge hit the Google Services segment specifically.
So if you take that out.
If you exclude that one-time legal charge, the operating income growth jumps from the reported 9% up to 22%, and the operating margin would have been 33.9% instead of the 30.5% they reported.
So a much stronger underlying picture of efficiency and scale benefits in the core business?
Much stronger, yeah, before you factor in that legal hit.
Okay, let's talk costs then. Total operating expenses were up 28%. It's a pretty big jump. Where did most of that increase come from?
Overwhelmingly, it was driven by R&D expenses. They were up 22%.
And that's AI related.
Mostly, yeah. It's higher compensation, sure, attracting and keeping talent, but a big chunk is that accelerating depreciation related to all the AI servers and data centers coming online.
So the spending confirms how intense this AI race is.
Absolutely. They're spending heavily to build the tech and secure the people.
But they also stress that they're focused on efficiency, right? It's not just about spending. What internal productivity gains did they mention?
Yeah, they emphasize efficiency as like an ongoing thing, not a one-off project. And they're using their own AI tools internally to get more productive.
Practicing what they preach.
Exactly. They gave two great examples. First, nearly half of all their software code is now being generated by AI.
That's huge for their developers.
Massive productivity boost for, their 20,000 plus engineers. Ship faster, potentially with fewer resources per project.
Okay, what was the second example?
Gemini-powered tools are apparently resolving hundreds of thousands of customer support inquiries automatically. And crucially, they're also driving hundreds of millions in incremental revenue for their sales teams by boosting productivity by over 10%.
So AI is helping their own bottom line through automation and efficiency.
Yeah, effectively boosting their internal P&L, which in a way helps validate the whole long-term investment thesis in AI itself.
Okay, let's finally tackle the elephant in the room. The biggest financial story, the capital expenditure surge. And the depreciation headwind that comes with it. The numbers here are just staggering.
This really is the core tension of the quarter, and it's why that huge cloud backlog number was so important to understand first.
So what was the CapEx number for Q3?
$24 billion in just 3 months.
And where did that $24 billion go?
The vast majority, like over 90%, went into technical infrastructure. They broke it down. About 60% on servers, which includes all those expensive AI chips, the GPUs and TPUs, and the other 40% on building data centers and networking gear.
So it's pure, deliberate AI capacity building.
Absolutely. It's the required investment to handle that token tsunami we talked about.
Yeah.
And to deliver on those billion-dollar cloud deals they've signed.
And the outlook for the full year 2025 CapEx, they raised it significantly.
They did. That really caught analysts' attention. They raised the full year estimate to between $91 billion and $93 billion.
$91 to $93 billion for the year.
Yeah, up significantly from the previous estimate, which was already high at $85 billion. This is just an historical level of infrastructure spending, probably one of the most aggressive investment cycles in tech history, especially relative to their current margins.
And it's not stopping there. They signaled more for 2026.
They did. They explicitly said to expect a significant increase in CapEx again for 2026.
Wow. Given they're already hitting $91 billion plus this year, a significant increase next year suggests, well, a multi-year phase of spending potentially hundreds of billions on infrastructure.
That seems to be the trajectory.
Why? Why the need for such relentless accelerating spending?
Because demand is still massively outstripping supply. Even with building all this capacity, management said they still expect the market for AI infrastructure to be tight, meaning demand higher than supply through Q4 2025 and likely throughout 2026.
So they have to spend this much just to keep up and capture the market share.
Pretty much. It's necessary to grab that market share from competitors while they can, and crucially, to actually deliver on that $155 billion cloud backlog they've already secured.
If they don't build it, someone else will. Or the customers just leave.
Exactly. Or the customers are forced to wait, which risks them going elsewhere. This CapEx, however painful it looks on the near-term financials, is basically the price of admission to maintain leadership in the AI race.
But that massive spending creates an immediate financial drag, right? The depreciation expense. Can you explain that again for listeners?
Sure. So depreciation is basically an accounting charge. It represents the cost of the wear and tear or the using up of those expensive assets, the servers, the buildings over their useful life.
And because they're bringing so much online so quickly.
That depreciation charge hits the income statement almost immediately. It's a non-cash charge, meaning actual money isn't going out the door for depreciation itself, but it does reduce reported profits.
And how much did depreciation increase?
It increased 41% year over year in Q3, hitting $5.6 billion.
And that's going to get worse.
Given the acceleration in CapEx, they explicitly said they expect the growth rate of depreciation expense to actually accelerate slightly in Q4 and into 2026.
So even if revenue keeps growing strongly, this faster depreciation will continue to put pressure on their reported operating margins for a while.
Exactly. It's the calculated cost they have to absorb now for the expected future benefit.
It shows a certain discipline, maybe, or necessity.
Both, probably. Building this kind of long-term, resilient, AI-driven growth profile simply requires absorbing these significant short-term, non-cash cost pressures. Investors really need to try and look past that immediate margin impact.
Yeah, focus on the growth and things like that. Cloud backlog.
Precisely. Focus on the $155 billion backlog that the spending is enabling.
How confident do they sound that this massive bet will actually pay off? Do they have a framework for deciding to spend this much?
They emphasize they have a pretty rigorous framework for evaluating these huge long-term investments. And it's basically predicated on seeing strong utilization, strong demand.
And they are seeing that.
They point to the early returns already visible in cloud, generating billions in AI revenue, expanding margins even with the spending, and the simple fact that customer demand is currently outstripping their supply. Well, that validates that these investments aren't just hopeful guesses. They're essential. They're strategic. They're meant to meet the demand that's already there. and hopefully secure long-term pricing power and leadership.
They're not building data centers and hoping customers will come.
No, they're building data centers for the customers they've apparently already signed up.
Okay. Before we wrap up, we should touch on Waymo. It's still in the other bets category, still losing money, but the sources suggested things are ramping up operationally, especially looking towards 2026.
Yeah, Waymo seems focused on really significant expansion, both geographically and in terms of what the service does.
Geographically.
They have ambitious plans to launch service in 2 major international cities next year in 2026, London and Tokyo.
Wow, London, Tokyo. And in the U.S.
Major expansion announced for Dallas, Nashville, Denver, and Seattle. Plus, they got permission to operate autonomously at both San Jose and San Francisco airports. That's a big step for usability.
And they're adding different service types, too.
Right. They launched Waymo for Business and also Waymo Teens accounts in Phoenix. So diversifying the user base beyond just, basic robotaxi rides. Usage for these is apparently increasing steadily.
But the really interesting part seems to be the future vision integrating Waymo much more deeply with Gemini and AI.
Yes. That's where it potentially moves beyond just being a standalone autonomous car service. The vision is for this deeply agentic integration.
What does that actually mean for a user? How would that work?
Well, management talked excitedly about using Gemini's conversational abilities and connecting that to all the data Google already has about you and your profile, where you're going, your hotel booking, your flight info,
Okay.
and using that context to proactively manage your transportation. So the system could pre-schedule Waymo rides for you or dynamically suggest them based on your real-time needs, integrating with your calendar and travel plans.
So instead of me opening the Waymo app,
Exactly. Instead of you manually hailing a Waymo, Gemini might see your flight is delayed, automatically adjust your dinner reservation time, and reschedule your Waymo pickup from the airport potentially without you having to do anything.
the AI agent essentially becomes your transportation planner.
That seems to be the goal,
Mhm.
using that deep integration, maybe using services like YouTube for better in-car entertainment tailored to you. The aim is to dramatically improve the whole travel experience, make it seamless, multimodal.
And they expect progress on that soon.
They said to expect new, deeply integrated experiences along these lines in 2026. It really positions Waymo less as just a car service and more as an agentic transportation utility.
Okay, we have covered a huge amount of ground today, from hitting that historic $100 billion revenue quarter.
Driven by, 1.3 quadrillion tokens being processed every month.
Right, to securing those massive multi-year billion-dollar enterprise deals for cloud.
The central story feels pretty clear now. This was really the quarter that validated their huge AI investment strategy. It confirmed the technology is driving real, immediate revenue results in cloud, and also through that surprisingly resilient monetization of search.
But the unavoidable flip side, the tension, is the sheer scale of the investment needed to make it happen.
Absolutely. Committing $91 billion to $93 billion in CapEx just in 2025.
With potentially an even steeper climb coming in 2026.
All necessary, they argued, just to meet the current urgent demand for AI capacity.
That relentless spending, that capacity build, it really is the defining feature of this AI race right now.
It is. They're betting billions and billions that controlling the entire AI stack from chips to models to platforms is the only way to satisfy the demand they have today and secure leadership for tomorrow.
Which leaves us with a final provocative thought for you, the listener, to mull over. Given this unprecedented CapEx escalation, we're talking tens of billions per quarter, with depreciation weighing on near-term margins and cloud demand still apparently exceeding supply. What kind of long-term structural change is this infrastructure war driving across the entire tech landscape?
Yeah, think about it. The entry fee to build truly frontier-level AI infrastructure is now stratospheric. It's measured in tens of billions, maybe soon hundreds of billions, over just a few years. So the question is, will these historically high capital costs effectively make it impossible for anyone but the current handful of tech titans to even compete at the cutting edge of AI infrastructure and platforms? Are we watching the consolidation, the solidification of an oligopoly in what might be the most powerful technology of the next decade?
Something to think about. Thank you so much for tuning in to the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.